our program here in the main hall. Ladies and gentlemen, if you'd like to, at this point in this hall, there will be 2 panel discussions. The first one is on IPO, how blockchain is disrupting venture capital and investment banking. The second panel on this stage is going to be state of the ICO market, cutting through the hype. If you would like to stay in here for the first panel discussion or for both panel discussions, please stay here. If you would like to go and see some of the exciting startup pitches and presentations for the second track, please head out that exit on the left side and turn left. For those of you who are just standing around having conversations, we are about to start our panel, so please tune them down a bit. All right. So, as I mentioned, the panel here is all about, will ICOs be the big disruption for traditional VCs, or is it just an alternative but not a disruption? The moderator for this panel will be Mark Badertscher. For those of you who are from Switzerland, you might read Handelszeitung, the weekly main business newspaper of Switzerland. He's a journalist there and will be moderating. The panelists will be, and I would ask you, Mark, to come up on stage, to have a seat, and then the panelists to please come up in that order and then also take a seat in that order as I announce them. First of all, Jamie Burke, founder and CEO of Outlier Ventures. Welcome. Kenzie Wang, managing partner of Super Bloom Capital. Eddie Travia, CEO of Coincilium. And finally, Richard Murhead, general partner at Open Ocean. So, welcome and have a great panel.
Thank you very much. Good morning, ladies and gentlemen. Let me just recap. We have here Jamie Burke. He's the CEO of Outlier Venture, and he's investing in projects related to AI, robotics, Internet of Things. And his point is, it's all about the network effect. And then we have Kenzie Wang.
Thank you.
From Super Bloom Capital, a hedge fund and an accelerator. And his point is, blockchain startups, they need us. And then we have Eddie Travis from Coincilium. Coincilium is an accelerator and investor in blockchain startups, and Eddie has a lot of experience in China. I don't know what his point is, but I'll make sure to ask him later. And finally, we have Richard Muirhead from Open Ocean. Open Ocean has been involved in starting, funding, and building internet businesses. He says the crypto boom is much more than just a new model of crowdfunding. Tokenization will lead to better allocate capital. And to start, we all know now that there is more money going to blockchain startups via ICOs than venture capital. William already said that. But my first question would be, have you been surprised how fast this went? Or was it more like, I told you so? Kenzie, start?
Sure, I'll take that one. Definitely super surprised. The velocity of changes in the blockchain funding space is changing so fast in so many ways. And it's catching everybody by surprise, especially Silicon Valley VCs as well. There's so much FOMO going on. And with all the regulatory changes, that's very fast-paced. So many new thinking and so many new processes are getting developed here.
Okay. Is there anybody who disagrees in the sense, well, I was surprised?
Well, I mean, as a slight counterpoint, I was kicking around in 2013, and a lot of people have got rich pedigrees in this space, and we've been through a couple of winters already in terms of the progress. So at that point in time, I didn't think it was moving fast at all, and even now, there's a lot of noise and heat And there is some progress, but I think we've still got a long path to go to really even understand how we embrace this new opportunity and make the changes to the approach to investing and so forth that we need to do.
Okay. What are the biggest differences between ICOs and traditional VC when it comes to funding startups? I know there are a ton of arguments why blockchain ICOs are appealing, but I just want to hear your favorite one. Jamie?
Yeah, so I mean, I think the key distinction to make as an investor is to think that you're not investing in a startup anymore. So if executed well, really you're investing in a digital economy, and actually you're backing a community to execute on that. So whilst of course, you have this core team that's effectively seeding the project and kind of birthing it for its first year. The reality is, if it's done correctly, it should be an open source project. And that kind of really changes the dynamics, because if you look at typical VC investing, 90% of startups will fail, and all value is lost, generally. So all know-how, all code, the teams dissipate. So that's a really inefficient allocation of capital. It's a really inefficient way to do innovation. What's most exciting about this space is that companies that would previously be developing proprietary technology and probably on that trajectory of in the 90% that will fail, are now looking at open sourcing their IP. And so for me, that's the most exciting thing. But it also makes investing in this space, I think, less fragile, which is why, you can talk about the valuations and all this kind of stuff, but you're not valuing a startup, you're valuing the ability of a community to execute on an open source project. And the great thing there is that it's much less likely to fail, because even if any one team fails to execute, it's open source, the community can pick it up. So I look at it almost as a relay race rather than a sprint.
Okay. Richard?
I'd like to pick up on that. I think, by and large, definitely agree. I mean, I'd also like to thank Olga for organizing such a tremendous event. I think we're all very excited by how many great people there are here. And then, stepping back a little bit, I started building software companies back in the 90s. And the way that I look at this is that, this is kind of the fourth age of open source. And you had the kind of very earliest age when it was the Turtle Pirates and Mavericks, or maybe the defense contractors who were involved in it. Then you had the effort to fund it through services and support. And then we've kind of got the end of the age now when open source has been captured by the huge megacorps who make money out of our data and software they don't actually own. And now this age is exciting because there's an alternative form of funding, and I agree with Jamie that some of the network effects there and the strength of the community mean there may be some, downside protection. And it's exciting because we have this fundamental invention around consensus algorithms and what I've taken to calling truth as a service, which you can get into interesting philosophical debates about what truth is. And I think when you combine those building blocks of open source software with the building blocks of truth as a service and the network effects that are possible, there's just a phenomenal wave of companies to be built or communities to be built going forward. And that's a great opportunity for venture investing.
Okay. You're talking about the network effect, Eddie. Do you see something different, or is that your main point as well? Why is it so appealing?
Yes, definitely. I think the network effect is a big part of this equation. If I look at it in a very personal manner, I remember in the 90s, we make a lot of this parallel between the 90s, all the IPOs at the end of the 90s, and this boom of ICOs currently. I see a lot of parallels. I see magazines growing, I see events getting full and filled with a lot of people, which is great. And I also remember that in the 90s, when I discovered internet, and it may be the case for other people, I was thinking, if I could just get $1 from anyone connected on the internet, I could fund so many things, right? And the main barrier to fund anything with $1 back in the 90s was, first of all, it was not as easy as today to send money around, of course. So the technical part, the cryptocurrency. But of course, the regulatory part, you were not supposed to solicit money from everywhere around the world, right? So I think the ICO has been opening the doors to something that the internet could have been doing before, which is basically tap into the wealth of the whole planet, really. And the only limit is today still, of course, the regulatory one. Yeah. But you still have people interested all over the world to participate in large companies. And we all know that it's not so easy to be in Facebook or in Google because you don't necessarily have access to the right people at the right time, etc. What is of a lot of interest to me now with the ICOs is this kind of, if we go back in time, so 2013, I started investing in this space. I saw a lot of challenges that the startups had, and I feel that ICO partly feels these challenges. I think there were challenges in terms of explaining to VCs their model. So sometimes the model didn't make sense commercially, very early. I mean, like Jamie was saying, open source. It doesn't make sense when you tell people you're going to own a company that doesn't own IP, right? So how do you make money? And then you have to go to the commercial model. But for many of these companies, including the ones that are doing ICOs, the commercial model and viability is not here so soon.
What does that mean for traditional VCs? Do they miss out? Are they on their way down?
Do they miss out right now by not investing in ICOs?
Yes.
Yeah, I think so. I think we're lucky because we are investors in this space. So naturally, we came into the ICO because we were in this space in the first place, not because we chose to start investing in ICOs, but just because a lot of the companies that I talk to now, they say, hey, we don't want equity. We don't want your money and give you shares. We just want to issue tokens and try to take advantage of that. Yeah.
Can I build on one of Eddie's points? I look at, and then talk about the second one, but I totally agree that, the question of the global allocation of capital is the most exciting one. So in about 2007, I was told by a hedge fund friend of mine that there was some very small single digit of the world's financial assets under management that were allocated to alternative investments. And I was astonished that it was just a few low single digits. And I was astonished that alternative assets included all of venture capital and all of private equity and real estate. And for me, this was, as a startup guy, this was crazy that such a small amount of the capital was allocated that way, and that the rest of the planet was sort of just sitting on that cash when we could be actually improving the world. And I think actually the numbers are a little bit higher than that as a percentage, I think, and it's kind of improving gradually, but it's still, we've got a long way to go. And if we can unlock that and then do it in an intelligent way, that's a tremendous opportunity. But the point about venture, I think, obviously, venture capital funds at the moment may be constrained by their limited partner agreement from investing in tokens that are not normal securities. But, of course, that's something that can be accommodated. And my point would be that the very essence of great venture investing is the relationship you can try and develop and win with the entrepreneur. And that is absolutely core to any of these new projects that are emerging, because you have to be, at the point at which you need to invest, that may be all that there is.
But I would say that the game's changed slightly in that, so I think somebody on one of the previous panels said, he felt that tokens would put a shadow upon equities in a very near future. Now, that's debatable, but one thing's for sure, that the contagion of tokens is breaking out of blockchain. It's going into a lot of deep tech, for example, AI, where we invest, where you need network effect, you need lots of data. So I definitely think it's something that's going to become a trend. And the challenge at the moment is, as you said, I know a lot of VCs that were previously saying, well, we have our term sheet with our LPs, we can't invest in these, and they found a way around it. Pantera Capital's one of them, and any number of others. So I don't think that's a problem. I think the problem ultimately is, and I'm sure we all get this, people don't come to us for money. I mean, really, they can raise more money than we've got in our fund in 30 minutes. You know, so what they want is somebody to help them navigate this space. And right now, where we're investing really heavily is in what I opened with, which was these are building digital economies. So this new discipline of crypto economics, which many dismiss and say, well, you can't have a new form of economics. It's not a new form of economics. It's basically how can you take behavioral economics and start to have these things designed bottom up with fiscal policy, monetary policy to behave like economies. And I think, you know, right now what we're doing is we're laying the foundations for the next digital infrastructure, the next economies, and therefore, as investors, what the communities need is guidance on how to structure these things. And most typical VCs just don't have that because they're not native to the space. Now, I'm not saying we have the answer. I mean, it's a totally new space. But for example, we have a partnership with Imperial College and their economics department and their computer science department. And so when we only invest now in tokens where we're involved in a bottom-up design, leveraging Imperial to build incentives and disincentives to make sure this thing behaves in the right way. And then we're even simulating how that performs in a lab environment using supercomputers at scale. So you know, it's finding different ways to provide value in this system, and it's definitely no longer just capital.
But like Richard said before, what is important is also the relationship to the startups. And if you buy shares, as a traditional VC, you stay with the company. But with token sales,
no, you should be locked in.
You should be locked in.
Some people,
but that's not.
Some people don't.
Yeah.
Because I'm sure you guys will expand upon this, but I think there's a lot of traditional VCs that will be dumping zombies on the ICO market this year because they want a liquidity event. So they don't want to be locked in. But for example, we opt to be locked in. Are holding vests alongside the founding team, but I don't know what.
It definitely offers a lot more flexibility in terms of liquidity standpoint. Breaking from the VC model for sure. So you give the entrepreneurs and also the team and also the investors a lot more option to cash out at different points.
But startups don't necessarily want that. I think
they don't want that.
They want a trader.
Yeah.
But they want an investor that's going to support them and help them grow.
It also, in a way, it's more decentralized. So previously in the VC model, where a lot of entrepreneurs have to go to different locations. For example, Silicon Valley to get funding. Whereas in this case, like Richard said, it's more globalization. And also in terms of category-wise, I've seen tremendous amount of new innovation in new categories because blockchain unlocks that potential for different industries. So I see, in addition to the traditional VC pattern matching on team product, there's also a lot more innovation in terms of this category of businesses that can be unlocked in this new funding mechanism.
Okay. And Eddie, please explain something to me. Now we see big traditional VC invest in new blockchain VCs in funds and things like that. They don't do it directly. Why don't they do it right now? Is it just because of regulation or other things, and will that change?
Yes, I mean what Richard was referring to is because a lot of VCs have mandates from the limited partners, and that could restrict the type of investment they do. We don't have any mandate. We are structured as an investment company, so we can do whatever we want, and so basically we could invest in any kind of assets. But so in that sense, also what is interesting, because you were talking about lock-in before, what is interesting is it's more transparent today. So basically, if people follow closely the ICO, they would be able to know if some of the large stakeholders are actually selling or not their tokens. So it's quite interesting because that's not usually the case with a VC. A VC, I mean, we are on a stock exchange, but VCs are generally not on a stock exchange, so they will be able to sell their stake and nobody knows, right? Or they don't really need to publicize it. So I think the tokens in that sense give transparency to the relationship between the investor and the startup. And so, of course, it would be better to show that you're supporting them and you're not dumping the tokens 2 months after the ICO or earlier. So I think that brings an additional layer of transparency in the process.
Okay.
Can I
Yes.
build on that? So, I mean, the beauty of the internet, the beauty of this is that there's the capacity for permissionless experimentation that applies on the product side. It also applies, obviously, on the funding side. The result is going to be the turbulence and that we've seen, the volatility that we've seen. But at the end of the day, really the best projects and the best investors are going to think about the reputation and their returns kind of long term. And so, we'll see an invention of what really works. That includes lockups, building on that point. And I was just reading something from Michael Kim over at Sundana Capital, who was suggesting, for example, that venture funds that invest in tokens should consider selling 25% of their holding if the price has done 10x. Because you can see that, the price, and you can see transparently what's going on. I'm not saying that that's the right answer. I'm just saying that people are thinking about what is the right model that respects the interests of the LPs, as well as the mission to build a great company. And I just want to build one further point that Jamie made. I think this is about blockchain. It's about decentralization, but it is about data and that truth as a service offering. And so I think there's an incredible intersection between data and the sovereign individual and zero knowledge proofs and artificial intelligence, machine learning, that we're just beginning to understand. So I don't think this is a kind of small niche in itself. It's a kind of fundamental component of many things, maybe most things.
It's the next web. I mean, you're right. I kind of still think of this as a niche, and it's only when I come to events like this or I bump into people on a plane, and I'm kind of just typing something and they look at me and say, oh, you're going to this ICO event. I'm like, oh, shit, I really need to be careful about what I'm saying in public now. And I still think of it as this niche, and we all kind of know each other from over the last few years. But this really is the next phase of the web. We are talking about decentralized web architecture and a new funding mechanism. The killer app of Ethereum at the moment is ERC20, right? So it's the combination of these things that make it really interesting. But to just pick up on one of the points around the idealized scenario is, yes, there's more accountability. But the sad reality is at the moment that this is incredibly opaque market. There's massive information asymmetry. So, for example, we would never buy something on the secondary market just because I know how little I know about that entity. So, we only invest in a handful of offerings where we're deeply involved in that entity. We can see what's going on, and we're actively involved. And I think ultimately the value for a VC, a native VC in this space, is to be a signal to the market. And so coming back to my earlier point, I think, if you're doing 20, 30 deals like the old VC model, that's a weaker signal than doing a handful. And I always kind of, if I were to say what would my model be, I won't go to this extreme, but it's a spectrum. But if you look at Joe Lubin and Ethereum, as far as I'm aware, his major exposure is to Ether and Ethereum, and everything he's done is build up a business to support that community to execute with consensus and stuff. And that's made him a very, very wealthy man. Rather than the typical VC model, because 90% would fail, where you have to have a portfolio of 50 or so. So, that's just my personal perspective, but I do think I carefully consider what is the signal that we're sending to the market, because the minute that we have no brand, we have no purpose. Because, again, they don't need us for money. That's one thing they don't need us for.
Is there a shift in power? I mean, now with the rise of the ICOs, more from investors back to the funders of startup, because they don't need investors and their money that much, because
they need the signal. I mean,
they're the signal. That's the point.
They're a public company, so this is one of the things. This is one of the things I don't think people really consider. So, when you do an ICO, you are a public company. And that's going to be a really big problem if you don't have a product, your team's never worked together before, and you've got a year a hard slog ahead of you that would normally, you're going to make a lot of mistakes, and you normally get away with those. But now you're scrutinized daily.
And you can look, you can look to the, the parallels, say, for example, with AIM in London, when you have sort of less mature companies, perhaps, arguably, I don't want to get in trouble with the London Stock Exchange, listing there, you've got to make sure that you continue to deliver. you don't want to get seduced by the short-term capital returns. You need to think about raising the right amount of money
And
then
communicating to
delivering
the
it
market
and communicating
effectively.
over a long period of time. So that's going to be key. And the real winners will be the founders who can be sophisticated about their capital raising and their capital raising plans.
Yeah.
Yeah, in a way, it's definitely giving more power to the founders right now, because there's, you're talking about a global network of investors that can invest in, new projects. At the same time, I also see that this funding model will continue to evolve. And the landscape-wise, I see, just like the traditional VC model, there's the accelerator, there's the seed funds, the micro VC, and then later stage VCs. I think very similarly, we're going to see the model getting more and more mature, and different stages of investment firms will be built on ICOs, and which, as this gets more and more mature, more branding around investment firms will shift that power back a little bit to the investors. Would you agree?
Oh, I mean, I'd say, I wouldn't say it's shifted to the founders because, again, as the VC, right, you're just one investor in a market of investors, right? So I actually think the power's in the market, and we're just part of that market, and we're a signal in that market. And so I actually think, and remember, most of this stuff's open source, right? So if a founding team fail to execute, they'll get forked. That's the reality of it. So I'd say the power is in the hand of the market. Our role is just we're one participant in that market. So the power shifted probably from the VC to the
it's just more open. It's very transparent in the supply-demand way. Whereas the Silicon Valley VC model, everything's under wrapped, and it's very closed up.
Agreed.
Here, it's a pure supply-demand model.
Okay, Eddie, you want to comment on that?
Yes, I wanted to go back to the relationship between investors and entrepreneurs. I think it's interesting to see how this is at the same time changing and not changing. So, for example, Jamie made a good point. He said a lot of entrepreneurs come to people like us, and we don't consider. I mean, in my company, we don't consider ourselves really like VCs, more like pre-VCs and seed investors. And you were right. You said they come because they want advice. But what is interesting is that they come thinking about what they want, and they don't necessarily know what they need. And that's something what investors in general can bring to the table, is that at some point, you were talking about listed companies and communication. A lot of companies and a lot of entrepreneurs may not want or may not know that they need to hear the bad news. The bad news, the tough decisions, the things that you have to deal a year after you started, maybe, because let's say you do an ICO and you raise a lot of money. There are many ways to spend it, and a year later or 2 years later, you may find yourself with tough decisions to make, people to fire, a fork in the road, as you were saying. And it's not always the market, it's also the founders have to take these decisions. And that's when you may need people with experience who have seen this problem over other startups, people who have created startups before. And this is where, the mentorship, the guidance part of the VCs or any investor really, can be a business angel investor, comes in. So I think that's a little bit the problem, is that it's fine that a lot of ICOs may say, well, we don't need investors in our capital because we can raise the money. Well, that's fine. But that's not the whole solution. You need to know how to handle this, and they're not, if you don't have the experience, it's quite tough to do it.
And it's part of the evolution here. I think, just like you said, on top of that, I think in 5 years, this model would continue to evolve. There will be sort of like a board structure from the public, or advisors that can step in and help these companies to signal to the market that this is actually a good team and a good project that will continue to survive.
Absolutely. I mean, I just want to say, like, from my experience, both building companies myself, but also investing now, covering sort of 70, 80 different companies and being on multiple boards at the same time. The time on the board when you're trying to help progress the company, just even have a great functioning board and set board meetings and discuss the points in the right way and the right order. That's even before you get to the substance of the points you're discussing, is super tough.
Okay.
And so money can't buy you love, and money can't buy you just an awesome board and an awesome set of startup skills. So
okay, we're already running out of time.
Yeah.
But just one more question. I would like to hear your answers. What is you're all advisors? So, what would you advise to the traditional VCs? What should they do now?
Start investing in ICOs.
Okay.
And they are already. Look at Filecoin, right? They already have $50 million of VC funding. I think that's going to be a trend in Silicon Valley. More and more VCs will continue to support the best ICOs, and which they will realize capital gain, and they'll participate more and more.
Yeah, I mean, the best VCs are already doing it, as you say, and have been for years in equity, in tokens, in a mix of the two from as early as possible. And there are unannounced ICOs that I am aware of with, absolutely, the world's greatest venture capitalists who are already involved, and that will be the path forward. But there's going to be a lot of great projects.
I think for a few years now, the money has not been it's not enough to say I'm a VC, I have some money, because there are a lot of sovereign funds, a lot of funds have been coming from anywhere, really. I mean, even before ICOs, crowdfunding with all its, I would say, it's not so easy, but crowdfunding with all its negative effects, etc., has been going on for a while, and so basically there have always been alternatives to VCs. I'm just thinking that VCs, I think we're already transitioning into this advisory, mentorship, guidance role, and that's what we see a lot through the accelerators all around the world. A lot of VCs are mentors to a lot of startups. So I think that's the right direction, and probably ICO could accelerate that direction, because then they realize, well, we don't have exactly the same edge anymore, so let's find something to bring. So basically, learning. VCs should just learn about the community, learn about the space, learn about what the founders need these days.
You said it, that's right, learning.
Yes.
I mean, I think there's going to be a tipping point. So, most of the people in traditional VCs that understand this space are the younger guys, and they're all leaving and setting up their own funds. So generally that's happening. And then within that, I think if you're just a VC or you're a capital manager and you're not going to provide any additional value other than monitoring the market, then effectively you're more of a hedge fund. And so I think that's going to be the difference. There's going to be a certain point where typical LPs are going to stop just giving money to a VC that doesn't understand the space, that can't add any particular value, any new value that's required.
Okay. Thank you very much, gentlemen, and that's the end of this panel. Thank you.
Thank you.